of the economy. They see growth now characterized as moderate, up from modest back in June. This decision was unanimous. Back to you.
Jennifer, we're going to be hearing from Fed Chair Jay Powell in just about 30 minutes from now. You mentioned the fact that the Fed did leave the door open for further rate hikes. What do you think investors are going to be watching for here in just about 30 minutes?
I think that Fed Chair Powell is really going to strike a hawkish tone here. He's going to continue to talk tough on inflation. Investors are really going to want to hear what it's going to take for the Fed to go to an extended pause. Wall Street thinks that this could mark the peak on interest rates for this cycle. However, officials not even acknowledging that cooler CPI print in their statement, they still characterize inflation as elevated. And thus, I think Fed Chair Powell will continue along those lines. And so Wall Street may be a little bit disappointed here. I think the Fed is going to stick to the script, and Fed Chair Powell is going to still leave the door open for an additional rate hike sometime later this year.
All right, Jennifer Schonberger, we'll let you go because we know you're going to be inside the room with Powell. We'll check in with you after the press conference. Thanks.
For more on the Fed's decision, we have Sonia Meskin, BNY Mellon Investment Management Head of U.S. Macro, right with us here in studio. We're also joined by Chief Economist Gregory Daco, along with George Bory, Chief Investment Strategist at Allspring Global Investments. So, Sonia, let's start with you. You heard Jen there talking about the decision, saying the Fed essentially didn't even acknowledge really the cooler CPI print. We know the Fed likes to say it's not just about one data point, but what do you make of the wording coming out of the statement today, given the latest economic data that we've gotten?
Sure. I think first of all, it's a good compromise between the hawks and the doves. You did see after the June pause, a few hawks come out and say, look, the job is not yet done. This is a good compromise between the two. I think it would have been difficult for them to strike a dovish tone just after they changed the summary of economic projections to in the more hawkish direction too. And finally, we all know that even though the headline and goods inflation are coming down, it's really now about, just as you guys mentioned earlier, it's about the services. And service pricing is much more closely correlated to wage growth than goods or headline inflation.
Greg, how about you? How are you looking at this? Because we've talked in the past that you expected this improvement that we have seen on inflation, but the Fed's still leaving that door open to future rate hikes. And also the change here in the statement, very limited. Does this make sense to you given some of the improvement that we have seen?
I think it was largely expected. We were expecting to see a unanimous vote after the unanimous vote for a June skip. We are also expecting to hear hawkish language coming out of the press conference from Fed Chair Powell. So I think the last thing policymakers want is markets starting to price in rate cuts by announcing that they have reached the terminal Fed funds rate. So you'll hear a lot of conversation talking about the fact that September, even the September meeting, is still live. We think this is the final rate hike in this tightening cycle, but you're not going to hear any trumpets announcing the end of this tightening cycle.
Greg, really quickly here, in terms of core inflation, we have seen that pull back significantly. If you consider we were at 9% a year ago, yes, we're not at the 2% target yet. But if you think about that extra 1%, the extra 2% that needs to get to 2% target, how much of that is in the Fed's control?
Well, I think it is still largely in the Fed's control because we are largely past the free lunch, the free disinflationary lunch from easing energy prices, from cooling food price inflation, cooling goods price inflation. But we are starting to see slower momentum in terms of final demand, in terms of consumer spending. We're also starting to see the lagged effects of lower housing price inflation that will feed through to CPI. It's going to take a little bit of time before we get back to that 2% target. Next couple of months are going to be bumpier in terms of CPI inflation, slightly tilted to the upside, but we're going to see core inflation move into the 3% range before the end of this year and likely around 2% around the middle of next year.
George, inflation, obviously the key variable here. The Fed seems to think it's way too early to declare a victory at this point. Do you agree with that?
We do agree with that. As we just mentioned, inflation numbers are coming down. And, what our read from today's announcement is, number one, the Fed needs to preserve as much optionality as possible. And they continue to do that. They emphasize, kind of data and the need to kind of keep an eye on things and kind of leave the window open, if you will, to sort of pivot or change, between now and pretty long period between now and September 20th. where they'll get a considerable amount of information to be able to decide what to do next. But they do need to preserve that hawkish bias, as one of the co-hosts, one of the co-speakers just mentioned. They cannot allow the market to believe that rate cuts are coming anytime soon. There's still a considerable way to go, and we're really into the heavy lifting phase of that sort of disinflationary trend, which is going to require sort of ongoing tightness from the Fed to keep sort of downward pressure on inflation. So it is much too early to declare victory.
So, Sonia, if we pick up on George's point that the Fed wants to maintain optionality, yes, potentially in the press conference, the Fed chair is going to signal that the September meeting is still live. Do you think it's live?
Yes, I do. I think that the tendency towards perhaps doing an every other meeting, doing a skip rather than a pause, is still there. But it really depends. I don't think they've made the decision just yet. And remember that on the inflation front, there are certain almost technical factors or base effects that are going to suppress some of these individual components of the CPI for the next couple of months. But that may actually reverse towards the fall, and the Fed is aware of that. And the market seems to not be paying as much attention to this in the wake of the latest print, but the attention may return.
What are those base effects?
Well, some of this is in real estate, for example. Some of it is also about the difference between the PCE and the CPI, for example. The PCE is less likely to be as subdued in the next couple of months as the CPI.
Greg, picking up on what Sonia just said, how do you think the Fed is going to look at that, given the fact that we have seen maybe this wedge start to form in those two readings, and the fact that they are signaling slightly different things when it comes to getting a handle on inflation, whether or not we are?
Well, I think the Fed is well aware of those differences. They look at a broad range of indicators when it comes to inflation. My main concern has been the backward-looking, excessively data-dependent approach that the Fed has been adopting. I think if you adopt more of a forward-looking approach, you see that the right types of developments are falling into place when it comes to the inflation trajectory towards 2%. We're not seeing the type of retrenchment that would signal a hard landing. We're seeing a cooling of labor market dynamics. That cooling, that slower pace of demand should feed into more disinflationary pressures. I, again, wouldn't be surprised to see that we have core inflation with a 3.7% reading towards the end of the year, and we are likely to move further into this lower territory over the course of 2024. As we were saying, this is not the end of the game when it comes to tightening monetary policy, but increasingly in this lower inflation environment, the Fed's going to be focused on real interest rates, and so we'll need less high nominal rates to keep the same types of interest rates on the real basis if inflation is indeed coming down.
George, you agree?
We would agree. I mean, as my colleague just mentioned, real rates kind of matter quite a bit, and it is premature for the Fed to sort of materially change its tack. The deceleration, the pace of tightening, is very consistent with end of cycle patterns. The risk is they are always the risk of over tightening, and by definition, the Fed will have to maintain kind of a tightening bias as we kind of go through the cycle. By the time sort of the data gives the Fed the all clear, it would be too late. And so they're going to try and fine tune this as we go into the end of the cycle. It's a notoriously difficult task, not impossible, just very difficult. And as we mentioned, they need to sort of keep containment on both, sort of liquidity, but also financial conditions, and actually keep, sort of the real rate of borrowing at a relatively elevated level to keep those inflationary pressures trending lower. We think this is actually going to be a fairly long and drawn out process, and that, we're going to be talking about this deep into next year, and that this is not sort of over yet from that perspective.
Sonia, what does all this then mean for the odds of a recession? We've heard Powell talk about the fact that a soft landing is still on the table at this point. He still sees a path although it's narrow, to a soft landing. Do you still see that as potentially likely here?
We do, and it's always been one of our scenarios, and I do think the probability has increased recently. And why has it? It's because we haven't gone into a recession yet. The consumer is actually still pretty strong, and in fact, I would somewhat disagree with one of the colleagues here in the sense that the labor market actually is quite a bit stronger than what would be consistent with 2% core inflation. We're having probably 2 to 3 times the monthly gains in non-farm payrolls than would be consistent with a stable 2% core inflation over time. So we need some deceleration there, certainly for inflation to continue to come down and not remain sticky above 2% in the core. Of course, this could happen over time without the labor market tipping over into recessionary territory, but you need corporate margins to also remain relatively healthy. You need the consumer, most importantly, to keep spending. And you also need the housing market to not fall off a cliff, which so far has not happened. In fact, it's stabilizing. And we know that structurally supply is probably lagging demand. So you combine that with a relatively strong labor market and a relatively healthy consumer. And I would say, yes, on the one hand, risks of a recession are probably receding, but on the other hand, there is still an upside risk to inflation there.
Sonia, you mentioned the relative strength of the labor market, and you know, you could argue that increases, to your point, sort of this case for a soft landing. When you look at average hourly wages, though, I mean, that has remained elevated. Why do you think it's that sticky? Is that kind of where we're likely to see it in the near future? Is it going to stay that elevated?
It's a very good question. I do think that even across metrics, not just the average hourly earnings, wages and salaries and compensation overall, we're getting the ECI on Friday, has stayed elevated relative to the previous cycle. Part of it, maybe not all of it, but certainly part of it is the supply-demand dynamic. So we actually have a smaller supply of labor relative to demand than we did pre-COVID. And in fact, those curves actually crossed before COVID hit. So COVID could have just accelerated some of these trends. And that is a tension that hasn't been yet resolved, at least in this cycle.
Greg, one of the rationales for higher rates is that tight labor market, the fact that that is propping up wages, and the fact that we're not going to see material improvement from here on inflation unless we do start seeing some weakening in the job market. How are you looking at that rationale, and is that making less and less sense given the fact that the labor market is still resilient at this point?
I think we have a unique labor market. We have a labor market in which business leaders are reluctant to let go of their price talent pool that they spend so much time hiring, training, and trying to retain. So we're not seeing the traditional types of recessionary developments where business executives lay off massively in order to cut costs. Instead, they're doing so very strategically, putting in hiring freezes, and you're seeing more of a hiring correction rather than a layoff correction. That means that the cost element is still central for business leaders. And that, in our opinion, is going to lead to some wage growth compression as we move forward. The developments are already there. When you look at the sequential momentum for wage growth, it's actually been quite encouraging. You look at small businesses, it's also been quite encouraging. So we think that those developments are moving in the right direction, and that even if you look at wage growth, those are very encouraging. And I would add one more thing in terms of the inflationary dynamics. On the PPI front, when you see some of the margins developments on a month-to-month basis, those are also very encouraging when it comes to inflation dynamics. That's going to be the key element. The core momentum in inflation is going to be what we should be paying attention to. And that, in our opinion, right now is moving in the right direction. There could still be surprises. Healthcare inflation could turn around by the end of the year. We've seen some stickiness in housing price inflation. But so far, the developments have been moving in the right direction.
We should point out we're continuing to monitor the market reaction to all this. Pretty muted so far, given the expectation that was largely baked in here of a 25 basis point rate hike. George, you're the fixed income guy on the panel here. And I want to ask you this because we haven't been talking a lot about the inverted yield curve. It has remained this way. I'm looking right now where the 2-year yield is at 5.4%, the 10-year is at 3.8%. How do we read this as even on this panel, there's increasing likeliness of a soft landing, that maybe this recession that we've been talking about for a year, maybe it's not coming or maybe it won't be quite as severe?
The shape of the yield curve is one of the most powerful factors in the market. And while, sort of history would suggest that a curve as inverted as the curve is today, would typically lead to a recession, within, say, 12 to maybe 24 months, we believe that there is, a very high likelihood that an inverted yield curve does result in a recession. The difference is timing. The yield curve there's nothing magic about the shape of the curve and the actual eventuality or the moment in time when a recession occurs. We've just looked back over the last 3 or 4 recessions, taken an average and said, it takes about sort of 12, 18, maybe as much as 24 months before you actually see a recession. An inverted yield curve does create meaningful kind of pressure on the financial system. It changes economic behavior. It pulls cash and money towards the front end of the curve. So we have not given up on the predictive ability or the messaging that comes from the shape of the yield curve. What we are sort of trying to calibrate is sort of how long. The economy is in a very different place than in prior cycles. And there's really 2 factors, one of which has to do with the balance sheet strength of many borrowers, corporations as well as individuals. We have a tremendous amount of low-cost debt that was effectively attached to a whole series of assets that sort of anchors the quality of different borrowers. And so if you have, if you finance yourself fairly prudently at a very low cost, you have tremendous amount of flexibility in today's environment. Those benefits are with us and they will be with us for a long period of time. And then the second component is this discussion around soft landing, hard landing. Our view is we're sort of in the midst of a soft landing, that the soft landing isn't coming, it's happening now. We have inflation coming down, we have growth going up, we have, good wages as we just discussed. Now the Fed is trying to sort of fine tune its position to keep those trends in place, but we think waiting for a soft landing is you will have missed the opportunity. The soft landing is now. The question is, if they need to keep raising rates, does the probability of a hard landing go up? And we do think that actually is occurring, but it is, at least 6 months out or further.
Sonia Meskin, Greg Dacco, and George Bory, really appreciate all of you joining us today with your insight. Thanks so much for your time.
Thank you.
Thank you.
Well, the Fed raising rates by another 25 basis points. Not a huge reaction yet in the equity markets. You're still looking at the Dow holding on to slight gains. S&P and NASDAQ, though, trading to the downside. Jared Blickery has a closer look at some of the movement that we are seeing here, Jared, in reaction to this.
That's right. We're probably not going to get the fireworks until 2:30 p.m. when Powell addresses us. But so far, a mixed market, some red and some green there. I'm going to go through the major averages first just to show you what's happened on an intraday basis. And here is the Dow. You can see dipped into negative territory just barely, and now it's green by about 12 basis points. Very, very slow and low range day here. NASDAQ did not take out the lows, and it is still in the red, but a little bit higher after the report. And here's the S&P 500. It actually took out the lows of the day and now is heading higher, maybe a little bear trap right there. And I do want to check out the VIX because the VIX is now hitting the lows of the day. So arguably the most bullish reaction that I've showed you so far. And then rates are ticking down on the long end. The 10-year T-note yield now down 3 basis points, was down a little bit before, but really not any cataclysmic moves in the bond market. Here's the US dollar index. That is heading south as well. And I do want to hit on gold. I was checking Bitcoin, not even going to show you, that hasn't budged, but here's gold, both up and down. Now, I just wanted to briefly show you what typically happens around these FOMC days. This goes back to the beginning of Powell's chairmanship, and then these two cover what happens. This is the night before. Here's Fed Day till 2 p.m., largely positive here, but this big red downdraft there, that is the Fed Day from 2 p.m. into the close, and that has been really poor lately. So we'll have to see if Powell actually does create any fireworks. Finally, the day tomorrow, post-Fed Day, that has been depressed, although very recently it has been ticking up. So those are the odds, guys.
We'll have to wait and see what we hear from Powell in just about 10 minutes from now. All right, Jared, thanks.
Well, here with more reaction to the Fed's 25 basis point hike is Dennis Lockhart, former Atlanta Fed president. Good to talk to you today. As Shauna said, we're 10 minutes out from the Fed chair taking the podium there. A very tricky line he has to toe here between sort of the expectation here of where the Fed stands right now, but also messaging to the market that September is still in play, so that there's not sort of that complacency, the expectation of now a cut down the line. How do you think he does that in this press conference?
I think he'll be non-committal about September or November in terms of a rate hike, but we'll certainly acknowledge that it's possible. He won't take any meeting off the table. I don't think he's going to suggest that the skip that we had in June and then the hike we've had today is somehow a pattern that they're locked into. I don't think that's wise. And he'll emphasize that there's quite a bit of data to come in between now and September, and the committee will be looking carefully at that data and deciding what the next step is.
Dennis, we certainly have heard from a number of Fed officials, Fed members, a number of them arguing or urging for more rate hikes, saying that we're far from really the point where we should be declaring victory on inflation. When you take a look at the recent prints that we have gotten, what do you think that last mile, that final battle is going to look like when the Fed is trying to get that inflation rate down to its 2% target?
Well, I think using the term last mile is a good device, because it's going to be, in my opinion, much more difficult to get from a run rate of 3% to a run rate of 2% on core measures that are not just headline and not reflecting volatility from month to month. And that could take a while. And therefore, I think that observers should be patient because I don't think the objective is going to be achieved anytime in the near term. It is probably a 2024 development, and maybe even later than that. So I'm in the hold for longer camp.
In terms of where that 2% target, there is a growing debate right now, not inside the Fed, maybe we haven't heard, at least publicly, about whether in fact that 2% target, what that target should be at 2%. Nobody expects the Fed, other central banks to change the rules of the game in the middle of this tightening cycle. But I'm curious how you view that. Should, number one, the target be at 2%? And if not, is the Fed's credibility that much more important? In other words, is it important to get to that 2% to hold the Fed to its word, even if that target is not necessarily where we need to be?
It's a really, really tough question, it seems to me. Much has been invested in 2%. 2%, I think, is the public's notion of what the Fed's objective is. That's what inflation expectations should gravitate to if you believe the Fed is effective in doing its job. It's an international standard, and when we in the committee made the decision to become an inflation targeting central bank, the international standard was part of the consideration. So there's just simply a lot behind choosing 2%. The big question in my mind is whether the nature of this post-COVID economy and the nature that will last for some period of time, maybe decades even, is simply different. And a slightly higher inflation target is more realistic given structural elements in the economy. That's a big cosmic question, and that's a seminar in and of itself, and I'm sure there'd be a lot of opinions on that. I just don't see them coming off 2%, quite frankly.
Well, Dennis, if they don't come off 2%, they remain committed to that 2% target. We've already seen this growing split, it seems like, inside the Fed right now as to what exactly the central bank should be doing or how they should be looking at some of the improvement that we have seen when it comes to inflation. Going back to that credibility part that you just briefly answered there, the fact that we do see this growing split, does that at all put at risk the Fed's credibility, given the fact that Powell has to figure out how to walk this very, very tight rope in his messaging and make sure that the market doesn't get too excited about what the Fed's doing, but also maintaining that balance with some of the risks that inflation still poses to the economy?
Well, I think, yes, Powell has, as he always has, a very difficult messaging challenge, both near term and over time. There has been some, I take it, serious discussion of communicating the inflation target as more of a range than a point. And I do think that's worthy of consideration. So what you may see in order to deal with this divide within the committee is a consensus building around the idea that the inflation target is between 1.75 and 2.5% or something like that. And when they get into that zone, they will feel that they have met their statutory mandate. So there are probably some messaging and communications things they can do that reduce any tension within the committee on this question, and at the same time achieve a little bit more realistic position given the structure of the economy and the way the economy is evolving.
You know, looking ahead here, sort of the question that we've been asking over and over is after all this talk of a recession, you know, when does that recession, if it in fact is coming, when does that materialize? How has your thinking on that evolved over the last, at least the first half of the year, as you look at the economic data points?
Well, if I go back further than just the first half of this year, my mantra was the longer inflation persists, the more likely we're going to see it end in a recession. And I've been proven wrong in that respect. Inflation has persisted, and I don't think a recession is imminent in any respect. It still may result in a recession, although I would put my odds on mild and you know, short-lived. But I have been really quite amazed by the resilience of this economy, the strength of the labor market, and that seems to continue. We have a virtuous cycle of employment, consumer demand, and therefore economic growth.
Dennis, what do you think the Fed needs to see in order for the Fed to be comfortable with holding rates steady, and also how they're thinking about the timeline of this higher for longer environment?
Well, remember, one of the debatable questions that the policymakers have talked about is whether they're going to wait for outcomes or whether they're going to make their decisions based on forecasts or outlooks. If the outlook is for achieving something close to the 2% target, they could pause, but there probably is going to be a contingent in the committee that would want to wait for absolute achievement, meaning proof that 2% has been achieved. And I think that's going to be one of the questions for later this year and into 2024 is on what basis will they pause? But what they would be looking for is convincing evidence. In my mind, convincing evidence is a series of largely similar reports that show, you know, very definite move in the direction of the target, with few anomalies that would somehow question the direction of inflation.
All right, Dennis Lockhart, thanks so much for your time. Really appreciate your insight.
Thank you.
And we are just moments away from that press conference with Fed Chair Jerome Powell over at the Federal Reserve. You know, Shauna, that last point that Dennis Lockhart made to me is really a key one, right? Do you wait for the outcome when you're talking about inflation, or do you base that on forecast? And that seems to be where the real divide is if you think about the FOMC and the divisions that exist. Yeah,
I think that is really the cause for this divide. And that's why the market, I think, is having such a tough time. Investors are having a tough time really trying to figure out what the Fed's future moves are going to look like, whether or not the Fed is going to risk and hike again before the end of the year, risk going too far. And of course, we could see that reaction in the economy, or if they're going to think that it is necessary because they haven't seen that outcome. They don't feel comfortable going off of that outlook here. All right, Fed Chair Jerome Powell is now at the podium. Let's go to him live.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. And we'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index. And lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market. The strength of the economy. Overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now, after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that, collectively, if that's our view, then we will do more.
Colby. Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has repeatedly proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions. And that's what this SLOOS will say.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Say, take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
Well, I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not
a large amount.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast as well as the individual participant forecast is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical records suggest that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. In effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong, aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is a restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Urbanovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, was there doubt? I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So. To continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now. And there are people coming in. A lot of the buyers are first-time buyers coming in, buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully, more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
Thank you.
Thanks very much.
Thank you. You've been watching the live press conference from Fed Chair Jay Powell on the back of the FOMC's latest decision here. I want to do a quick market check here, brought to you by Tasty Trade. As we see the markets react, we have seen all three turn negative here. The Dow now down 21 points, the S&P 500 down 15, and the NASDAQ down 72. Also taking a look at the VIX, the fear gauge here, we are seeing that also pushing lower at down about 3% here. And Chana, we've also been watching the bond yields, as we always do on Fed Day, and we've seen some of those pull back too. Interesting notes coming through from the Fed chair and his comments on this. You know, optionality is something we talked about going into this, and very clearly the Fed chair making clear that yes, the September meeting is still a live meeting. No, we have not made a decision beyond that. This is a meeting by meeting decision. But he also made clear that, look, we have made strides and we can afford to be patient.
Yeah, that stuck out to me just in terms of the fact that I thought he did a very good job of walking that fine line, right? We went into this press conference wondering whether or not that message was going to be clear to Wall Street, and judging by the market's reaction, or really lack thereof, it is very clear, I think, that investors are pretty split on exactly what the Fed is going to do next, going back to that point that he made over and over and over again, that the Fed is going to remain data dependent, and that it could actually afford to maybe pause at their next meeting in September, then potentially reassess a rate hike for later this year, whether or not that's warranted. Another thing that stuck out to me, Akiko, was what he was talking about in terms of wages and the labor market, and how the labor market has been very resilient up until this point. Wasn't necessarily worried at the start of this battle against inflation about how wages were playing into the inflation debate, or the rise that we did see in inflation. But right now, he's taking a closer look at that inflation number, at wages, how that's factoring in, and thinks that it's going to be a pretty important factor as we talk about that last mile there, getting potentially the Fed getting inflation back to that 2% target.
Yeah, and the question, we keep talking about the last mile because that has been the stickiest part of inflation. The question increasingly, I think, is how much of that is in the Fed's control? How much of this is because of monetary policy? He was asked that directly and said higher rates have slowed the housing market. Monetary policy is key in non-housing services, but there are also conditions we've talked about over the course of the pandemic which have been inflationary. That's not necessarily controlled by the Fed. If you're thinking about supply shortages from supply chains, those have started to ease, and that's really where the split has been happening, which is to say those who say you need to continue to hike rates until you get 2%, and those who say the Fed has done its job, now let all the other factors take shape.
Yeah, well, let's talk a little bit more about this. We want to bring in another voice here who's just watching Fed Chair Jerome Powell's press conference after the Fed raised rates once again by 25 basis points. We want to bring in Brent Schutte, Northwestern Mutual Wealth Management Chief Investment Officer. Brent, it's good to see you. So we were just talking about the lack thereof of the reaction that we're seeing in the market right now. It seems like investors are pretty split on what the Fed is going to do from here. What did you make? What is your assessment of what we just heard from Powell?
Yeah, I think you nailed it pretty good in your opening comments there, talking about how he kind of walked that fine line and really talked about being more patient and having done quite a bit already. I think the big thing here, and this is where you made some comments on wages, and he kind of shunned it off just a bit. But this, to me, is the most important thing that's out there. This is the last frontier of inflation. So all you talked about, the CPI stuff, that is coming down because it was tied to COVID. That's where we were optimistic because we believed that would come down because it was tied to COVID, and we're moving further past that, and it has. Unfortunately, the Fed worries about wage inflation, and wage inflation has not come down because the labor market is still tight. And so to me, the Fed doesn't want to repeat 66 to 82, where wages rose pretty much from 3.7% all the way to 9.4% by early 1981. They were pretty much up, and they pulled that CPI back higher. To me, Jerome said it best, Chair Powell said it best when he said, we want to get wages down to what is consistent with 2% inflation. That number, my answer, is, or has been, at least in the past, according to the Fed, around 4%. We are at 4.7% year over year on wages for non-supervisory and production workers. And the last three cycles peaked out around 4 to 4.4%, which is what the Fed targets. And we're still above that. And so that's why I think they'll have to keep going until they see the labor market break, which to me is exactly what he says is not going to happen. We call that a recession. And so I don't think they're going to get out of this without causing a recession unless magically a bunch of people come back to provide labor.
So Brent, let's talk about that level that you think wages should be at. The next question is how much of that has to do with the Fed? How much of that policy is already taking shape? How much of this is about just waiting for it to take shape even further? The hawkish camp, of course, would say you've got to hike rates yet again.
Yeah, perhaps. I mean, this is where he doesn't know, nor does anybody else really. I mean, when does the job market really start softening? I'm surprised how resilient it has been. I thought it would have softened by now, just given the cumulative impact of rate hikes. And you actually have seen some softening. But certainly wages are the price mechanism the Fed looks at. And as I mentioned before, wages right now pretty consistently on a 3-month, 6-month, 9-month, 1-year basis are at 4.5 to 4.7%, which is above kind of that non-inflationary ceiling the Fed put on the prior 3 cycles, and that was around 4%. And so how do you get that to come down? You get that to come down typically every one of those time periods ended with a recession. And so I don't think the Fed is magically going to land this one right where there's no job losses and wages come down. I think there's going to be job losses, and that's why I think there's going to be a recession.
So, Brent, this might be a little bit hard to predict, but when you talk about the fact that the labor market could break, we need to see, or we likely will see, job losses in order to get wages down. What's the extent of those job losses, and what does that mean in terms of how deep of a recession we could potentially be in at that point?
Yeah, this is where I think it can be mild. I mean, look, the Fed policy right now is at 5.25 to 5.50. If the neutral rate is 2.5 and inflation goes by the wayside, so I think current CPI is going by the wayside, I think wages could pull it back up. But if wages fall, current CPI is low, I think the Fed can cut if they need to, probably fairly aggressively. And I do think monetary policy has a more immediate impact in today's world. So I do agree with those comments from some other Fed governors. And so that's where I think they can keep it mild if they have to, because I think inflation is going to be completely eradicated from the U.S. economy if we do have that recession, and that will keep it more mild.
So, Brent, ultimately, what does that suggest in terms of the trajectory of the Fed's policy going into year end? Will we see another rate hike, or is another rate hike necessary?
That's where I don't think the Fed knows. They're data dependent, nor do I think anybody on Wall Street knows. I mean, to me, we're at or near the end. You've seen jobless claims. I know they're still low. They've ticked up. I think everybody thinks that before a recession, the unemployment rate spikes, jobless claims spikes, but that's not the case. And so you've already seen moves in jobless claims and continuing claims that have been consistent with recession starts of the past. And so I think we're knocking on the door. We're certainly not there yet. I think it's likely that the Fed is near to the end, but I do think there's probably still at least one more hike before the job market breaks. But that certainly is not a perfect analysis. And I just think, I think to me, investors should focus more on this is what end of cycles look like. And that's where if we don't have a recession in the next few months, the next few quarters, I don't think you're years away from one, because we are out of workers to provide labor. And that typically is the end of every economic cycle. And so is it 3 months from now? Is it 6 months from now? Is it a year from now? I think it's well within each and every one of those time periods that you're likely to have one.
So, Brent, what does this mean for investment portfolios? How defensive should investors be given the fact that there's so much uncertainty still?
Yeah, I mean, this is where I think there's good news. I think most people who listen to your show own fixed income. And to me, fixed income has completely repriced to now yielding somewhere around 5, where it yielded 1.75% before the Fed started hiking rates. And that was when inflation was running at 7. Now you're near 5 on investment grade bonds, and inflation is faltering. And so I think, once again, bonds are a hedge against equity market downside and offer real value as inflation falls. And so certainly that's an area we've become more defensive. I think the other good news is that if it's a mild recession, I don't think the market has to make dramatic new lows or even make new lows. And I think there are cheap parts of the market that should do fairly well in a mild recession called small and mid caps, which trade at 14 to 15 times earnings. They typically don't do well in a recession. But again, they've discounted some of that. They're cheap. And I think investors can own those through the recession. And the opposite side of that can be very strong for them.
All right, Brent Sheedy, always great to get your perspective there. Northwestern Mutual Wealth Management Chief Investment Officer. Thanks.
Thank you.
The Federal Reserve once again deciding to raise rates by 25 basis points, pretty much in line with what economists were expecting for this meeting. Chair Jerome Powell just wrapping up his news conference. Let's head out to Yahoo Finance's Jen Schomburger, just getting out of that press conference as well. Jen, what stood out to you in the comments we got from the Fed chair?
Hey there, Akiko. Yeah, Fed Chair Powell says the Fed isn't quite ready yet to declare victory on inflation. While he was encouraged by the June CPI report, he still thinks there's a long way to go on inflation and that policy, while restrictive, maybe not be restrictive enough or been restrictive for long enough. Take a listen.
I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Powell says the Fed is going to need to see more inflation data from here. It's going to depend whether it comes in cooler, the same, or even hotter than what we saw in June. He really needs to see supply come back into better balance with demand before the Fed is comfortable to hold for an extended period of time. Now, Powell says the Fed is not following a strategy of going every other meeting, that every meeting will be live, and that the committee has not predetermined what its policy moves will be over the next couple of meetings. Now, I also asked Fed Chair Powell about credit conditions, given that we're now over 4 months since the failure of Silicon Valley Bank. He told me it's kind of difficult to tease out the impact on the economy. Take a listen.
In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth.
Now, Powell does see a pathway to bringing down inflation without causing steep losses in the job market. He did note that Fed staff now see a slowdown later this year. That's an upgrade. Earlier, the staff was projecting an outright recession later this year. Bottom line here, though, this is a Fed that is still keeping its options open for further rate hikes. Chair Powell not backing away from that this afternoon. Back to you.
Okay, Jen Schonberger there reporting live from the Federal Reserve. Appreciate that. Thanks so much. Well, coming up, we're going to continue to break down the market reaction on the back of the Fed's latest decision to hike rates. We're going to take a quick break here. We'll be right back.
The Fed raising rates by another 25 basis points today, pushing interest rates to the highest levels that we've seen in 22 years. Here with more on what we just heard from Fed Chair Jerome Powell, Alexandra Canal, Josh Schaefer here joining the roundtable discussion. And guys, there's lots to dig into what we just heard from Powell, but I want to start with some of the comments that we heard about the labor market, where things stand right now. We know the tight labor market has been an issue for the Fed in its fight against inflation, in its fight to cool inflation. Let's take a listen to what Powell had to say.
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there, and by so many indicators, labor market demand is cooling.
So labor market demand cooling, talking about the fact that the supply and demand balance getting better into balance at this point. But wages, Josh, has been such a massive issue here for the Fed. And he kind of downplayed maybe some of the risks there. We just heard from Brent Schutte earlier in the hour, and he called this kind of the last frontier when it comes to the Fed's fight against inflation and some of the weakness that we would need to see in order for the Fed to get to their target.
It's an interesting part, right? Because it's the part that you haven't really seen play out yet. Chair Powell also talked a lot about the fact that we've already seen a lot of why inflation has come down hasn't necessarily been all because of the policy, right? You've had inflation come down for a number of reasons, and now you're at the point where you do need people to probably have less money and be willing to pay that extra amount, that little 1%, that last mile that we've talked a lot about. And I think this is where you really do need to see the labor market slow down. And so he's kind of projecting in the future almost, because you look at where things have gone right now, and he pointed to it at 1.2. I mean, the labor market is relatively healthy. The unemployment, it's tight, but you could say it's healthy too, right? The unemployment rate flat since they started this process over a year ago. But are you going to be able to get inflation all the way down without that unemployment rate ticking up? He sort of hinted at probably not. That's just not historically how it's worked. I think the question is how much.
But, well, I was just going to say, on the historically is not how it's worked. We're also coming out of a pandemic. So it's a very different environment than we've been at before. So I do wonder if that changes the caliber of what the Fed needs to do moving forward. I mean, Jerome Powell did say that it's a, quote, real blessing that we've had a disinflationary environment while the labor market continues to outperform. But I just wonder in this post-COVID economy if the rules of the game are just different.
Well, I mean, this is really where the divisions lie, right, within the FOMC. And we were talking about this earlier in the show, but it is about how much of that additional 1%, the 2%, depending on which metric we're looking at in terms of inflation, how much of that will be in the Fed's control. And to your point, Ali, if you think about where inflation has gone, a year ago we were at 9%, roughly 9%. So much of that was because of what happened during the pandemic, the supply chain snags, having the shortages. A lot of that has eased already. And then it becomes, well, to what extent can monetary policy get you to that last mile, to that 2%? The Fed chair doesn't want to be seen as saying, well, we want people to lose jobs. That's not the messaging he wants. But at the same time, the very quote that Brent Schutte talked about, which is that, at the end of the day, we want wages to go up with a pace that is consistent with the 2% target. And that, I think, is key.
Yes, we want wages lower than how much they're increasing right now, right?
Exactly.
That's why it's key.
Yeah.
And is that actually right? And is that going to come? I think is sort of the interesting piece of that. But I thought it was also interesting too. He kind of got thrown it's looking more like that soft landing might happen a couple times. He could have maybe taken a little bit of a victory lap when it comes to that, or at least said, things are looking better, and he never really bid on that. I thought at least multiple questions left that open for him to say, things do probably look a little bit better than they looked a month ago or 2 months ago. And he said, well, I've been in the same camp the whole time. But I thought that was an interesting part of it.
But the risk is about reacceleration of inflation, right? I mean, and that's really key. And that's why we heard him say over and over that it's been restrictive, but it's not been restricted long enough. Now, if you're in the market and you're listening to it, that doesn't really answer the question of, does that require another rate hike, or does it mean that we're going to remain at this level for much longer? And
I think that really also points to the fact as to why Wall Street is so split on this. We heard from a number of, on the buy side, on the sell side, coming into this press conference, into this Fed decision, that there's a lot of uncertainty about what the Fed is going to do from here on out until the end of the year, whether or not another hike is warranted. I haven't taken a look at the CME Fed Fund futures after this decision. All right, so you're going to...
It's basically flat.
Basically flat.
Which is basically what the market is, too, right? Even stocks today.
So then
stocks are back to where they were before the meeting.
And so then I think that you can argue the fact that Jerome Powell did exactly what he intended to do and wanted to do in today's press conference. The lack of reaction that we saw in the market, the lack of real any difference that we're seeing in terms of the projections coming from investors, I think that that means he walked that fine line. He did it well, and he was still saying, and he said it a million times, that the Fed's leaving its door open. It's going to be data dependent.
All options on the table.
All options on the
maybe
table.
we do. It's the summer of choice, right? You're going to see Barbie or Oppenheimer. Are you going to hike or you're not going to hike?
I love that he got the Barbie question, too.
Of course, that was amazing.
I thought Morgan Stanley put it really well. They said, why rock the boat? When you have it priced at 99% that you're going to hike, you do the hike, right? You talk about the fact the economy is strong. He took a couple nice jabs there about things going well, pointed out everything that's obvious, everything that's data dependent that you've seen, and then said, we'll see in September. We haven't really decided anything, and sort of said basically nothing. He moved the market up a little bit. Stocks were up for a little bit. And then he reminded everyone that we're not going to get to 2% inflation until 2025. And stocks went right back to where they were. And I think just that's the overall takeaway for me here is you still have about a 30% chance that we get another hike by November per the CME Fed Watch tool. It was a little bit over 30% 24 hours ago. Again, stocks basically not moved since the meeting started.
And I think to see more inflation reports, that's going to be key because he said, it was just one reading, right? The June report that we got that came in positive. He welcomes the good news. And, many forecasts are calling for inflation to stay low, but he said that is hard to just go off the forecast. They need to see the data, and that's going to be key whether or not the Fed decides to hike in September.
It's a good use of time, right? You have until September. You have multiple more inflation reports. You have 2 more jobs reports. Why comment too much on one report and make too much out of it if you really don't have to?
That's the Fed chair's way of just keeping the door open on both directions.
And
right?
we did. And we've got 8 weeks to now discuss what exactly we think the Fed is going to do next. All right. Allie, thanks so much. And of course, Josh as well. Well, coming up, Tesla's charging network facing new competition. Plus, a busy day for Stellantis. We are shifting gears and checking in on the auto sector. We'll be right back.
Well, Tesla's charging network facing new competition as 7 car makers join forces to create a new high-powered charging network. Here with the details, we have Yahoo Finance's Pras Subramanian. Pras, this is an interesting alliance that also includes those who have aligned themselves with Tesla before.
Yeah. So 7 automakers, like you said, BMW, GM, Honda, Hyundai, Kia, Mercedes-Benz, and Stellantis joining this sort of joint venture to spend close to $1 billion, what the journal is reporting, on a 30,000 plug network across North America. Interestingly, it will include both the CCS, which is the standard connector, and the NACS, which is Tesla's de facto, or almost going to be the de facto standard in the US. That's sort of what people are thinking. But this is a way for the automakers like GM and also Mercedes and also BMW to kind of strike their own path and sort of have their own destiny in the charging world. They want to try to actually kind of have a competitor to Tesla, but also they'll use that standard, and they need to use that standard because they need to actually get some government money to build out this network, and that's how you do that, is by being open source in some sense.
And Pras, when it comes to, Stellantis, it was a busy day there for that company. They're involved in this venture that we're talking about here, but they also reported results, and we've gotten a number of reads here from the larger automakers about demand, what that picture looks like right now. And coming from Stellantis, it looks like it's another solid report here.
Yeah, this follows GM's pretty strong report on yesterday with their Q2 numbers. This is Stellantis' first half, so it's both first quarter and second quarter. $108 billion in revenue, up 12% from a year ago. Free cash flow up 64% from a year ago. Now, margins dipped a little bit compared to last year because of the fact that they had to lower pricing for competitive reasons. There's some concern there that it might have to keep prices low to keep up with other competitors, but nonetheless, I think it sounds like they're sort of positioned to actually do that. Big picture is their EV transformation second half of the year. 2 cars coming out, and then next year you have the new Dodge Charger Daytona, the Wagoneer S, Jeep Recon, and then the Ram 1500 REV EV pickup. So it's a big year for them from an EV point of view as well.
Yeah, it feels like increasingly 2024 big year in EVs in general. A lot of releases coming through. Pras Subramanian, thanks so much for that.
The Federal Reserve raising interest rates to a 22-year high as expected, and Fed Chair Jay Powell saying that inflation won't come back to its 2% target until 2025. Joining us now is Mass Mutual CEO Roger Crandall. Roger, it's great to see you here. So let's start with the Fed's decision today. What does this mean for your business and how you're positioning Mass Mutual at this point?
Well, good afternoon. Really pleased to be here today. I mean, you were just saying in the previous segment, 99% of the people asked and the economists thought they were going to raise rates a quarter. That's just what they did. Markets basically didn't move. So I think the Fed delivered on what they told us they were going to do. And they, as the press conference showed us, they're going to continue to make sure that inflation gets back down to their 2% target one way or another. And so far, the economy's held in really well. Jobs have held in really well. Financial conditions are much better than they were after the crisis. So for Mass Mutual, this continues to be a positive for our policyholders and will allow us to continue to invest for the long term for them.
Yeah, I mean, but what does it ultimately mean when you look ahead in terms of you consider the trajectory of the Fed, and I guess that's still a big question mark. But as you think about your business, how do you position yourself for the long term, or at least the medium term?
Yeah. Well, I mean, look, for us, the medium term is like 10 years. Right? We are a very long-term company. And so we look a lot at the underlying strength of the companies that we invest in, the securities that we own to back our life insurance policies, and making sure that we're going to have the financial strength to be there. So frankly, whether the Fed ends up having the terminal rate be 5.5, 5 3/4, or 6 in this tightening cycle is much less important to us than making sure that the American economy continues to perform well. And I think you give the Fed a lot of credit. So what we're continuing to do right now is to invest for the long term, to make sure that when the 7 million folks who are owners of our company and policy owners of Mass Mutual, we're going to be there when their families need us, like we've been doing since we were started way back in 1851.
Roger, what about the latest when it comes to the banking sector? We know Powell from our own Jen Schomburger got this question during the press conference, and you were saying that things have settled, but the Fed is still closely monitoring what's playing out right now within regionals. I know it's something that you were closely watching back in March. On the heels of the news yesterday with PacWest and Bank of California merging, does that reassure you that the government didn't need to be involved in that deal, or is that maybe some rumblings there showing some signs that we could see more stress within banks in the near term?
Yeah, I think it's hard to envision that 5 or 10 years from now, we're not going to have fewer banks in the United States. I think this is going to be the first of many combinations of smaller and mid-sized banks as they try to get scale to compete against the very large banks that are out there. I think it's a really good thing that private capital came into this deal. Remember, we really couldn't work our way through the last failed bank without one of the really big banks getting even bigger, which I suspect policymakers didn't really want. So I think we're going to continue to see stress on the small and mid-sized banks as their deposit costs rise. I think some of them are going to have some challenges on the asset side, particularly with some commercial mortgages and particularly office. But I can't envision that if you look at 5, 10, 15 years in the future, that we're going to not have fewer banks in the U.S., and I suspect there will be many more combinations like the one we saw today. Again, really want to highlight it's really critical that private capital have confidence in the system to invest. So seeing $400 million get injected in here, I think is a really good thing for the health of the system.
Roger, you were just saying that, at the end of the day, MassMutual is about the long-term plan here. But this comes at a time when we've heard increasingly that Americans in this macro environment are really concerned about what that future looks like, what their retirement looks like, how their savings are being depleted. I wonder how you're seeing some of those concerns, that anxiety being reflected, at least within your business. What are those customers seeking out?
Yeah, so we have 7,500 financial professionals in the MassMutual Financial Advisory Network, and they're talking to people every day. And I think where we see it is there's a real demand to talk to a financial professional that's on your side. To help make sure that whatever happens in the years ahead, you and your family are going to be situated as well as possible. So that means insurance products, as you'd expect. At the end of the day, making sure you're protected if someone dies early is really important to a family, and that's something that's core to what we do. But also disability income insurance. Most people's biggest asset is their ability to work. We just heard how the labor market's holding in really well. But if you get injured and you can't work, disability is really important. And then with over 10,000 Americans retiring every day and the country continuing to age, it's really critical that you begin saving early and have a plan. Because, look, we don't know whether the S&P is going to stay at the high levels it's been at in the recovery this year, or whether it could have another bad year like 2022, and whether the 10-year is going to go to 5% before it goes back down to 2%. All those things are possible, right? What a financial advisor does is works with you and your family's particular situation to maximize your chances for success. So that concern talking to people. But when people have a plan, they feel better. And I'm really proud of the number of families at MassMutual's helping today put a plan together and then execute on that plan over time.
Certainly important to have a plan that's intact at a time like this when there is so much uncertainty out there. Roger, great to have you here. Roger Crandell, CEO of MassMutual.
Thank you.
Well, we continue to keep an eye on inflation with several restaurant names set to report earnings. Chipotle just moments away, but on Thursday we'll hear from both McDonald's as well as Sweetgreen. Brooke DePalma all over the food beat for us with the details. Brooke, what's the expectation here?
Yeah, well, pretty high hopes for the Golden Arches here from Wall Street. Revenue expected to come in around $2.67 billion, up 9.6% year over year. Adjusted earnings per share expected to come in at $2.78, according to Bloomberg estimates. This as McDonald's look to be a go-to place for value as consumers remain pinched by that inflationary pressure. In addition to that, McDonald's doubling down on its digital and marketing strategy in their MCD approach. That's marketing core items as well as doubling down on digital delivery as well as driving restaurant growth. Now, in addition to that, U.S. sales expected to increase here, up about 9%. In addition to that, overall same-store sales expected to increase about 9.36%. But something to look out for is lower adjusted operating margins impacting company-owned stores and international operating markets. So that includes Australia, Canada, Germany, and the UK as inflation overseas in Europe, particularly when it comes to food, continues to remain higher. Year to date, McDonald's up about 11%. And honestly, what I'm looking out for, the Grimace Shake. Of course, that's created so much buzz on social media, and Wall Street certainly looking out for the results from that as well.
Still upset I never tried it. Did you try
Well,
it?
now we
I've
can't.
never tried it. And now we
can't.
can. I know.
I really saw the viral trend, though, Akika. We were talking about it the other day.
And all over TikTok. Exactly. That's what made me think I needed to go get it, and I didn't do it. All right. Anyway, Brooke, the other stock that we have in company that we're going to be hearing from is Sweetgreen. Shares have certainly been on a tear over the last couple of months. What are we going to see there?
All right, don't call it a comeback yet, but lots of hope around this earnings report for Sweetgreen. They're set to report Thursday after market close. Walmart expecting earnings per share to be down 18 cents. Revenue expected to come in around $156.4 million. Now, same-store sales expected to increase here, 4.10%. Some highlights, some drivers that Wall Street is keeping a close eye on to lead this earnings results include that chicken and Chipotle bowl. Of course, they got into a bit of a litigation with Chipotle there. They also took a 1% price increase in the beginning of the quarter. They launched Sweetgreen Plus. That's sort of a membership loyalty factor this past quarter. In addition to that, we are seeing lower commodity prices for tomatoes as well as chicken. Lots of people lots of analysts on Wall Street certainly looking to that for a bright spot this quarter. And of course, this all comes as Sweetgreen has really come back into the picture as a new competitor came on to the market. Of course, that's Kava there. And in addition to that, Wall Street really eyeing on when Sweetgreen will turn profitable. Right now, they're eyeing next year, 2024. And so any mentions of profitability on the call will be something that Wall Street analysts will be looking for.
And also certainly want an update on that timeline. All right, Brooke, thanks so much. Coming up, almost time for the closing bell on Wall Street. We're still looking at a mixed picture here. The Dow holding on to slight gains, up just 34 points. S&P and NASDAQ, though, trading to the downside. We'll be right back. That's the closing bell on Wall Street. Let's do a check of the market sponsored by Tasty Trade. You're looking at a mixed picture here as we shake out the final trades of the day. Investors digesting the latest 25 basis point hike from the Fed. The Dow closing up just around 84 points. S&P right around the flat line. You have the NASDAQ closing in the red, off just about 0.1%. Let's take a look at some of the individual movers, starting off with Boeing. Shares closing to the upside, up over 8% after the company beat on earnings. They cited shrinking losses, rising delivery figures in its second quarter. Pretty strong report here at Kiko. When you dig into some of these numbers, production stabilizing there. We know that they have had years of troubles when it comes to this, certainly a number of issues for Boeing over the last several years, but their output, that's up 23% to 38 jets a month. Obviously, a huge step in the right direction for the company.
Yeah, quality control issues that are internal to Boeing, but also other pandemic-related issues that have slowed down the production for Boeing. And it's certainly that positive news overshadowing what is essentially you could argue negative losses in defense and space business there as well. So some positive and negative as well. But Boeing ramping up production of its MAX aircraft. They're looking at 38 jets a month, up from 31 a month, and then also reiterating their forecast on the 737 deliveries. So things certainly looking positive on that front for Boeing.
Yeah, things are looking positive. We mentioned that jump that we saw of over 8%, the highest intraday levels that we've seen in the stock since January. So we've seen investor sentiment improve when it comes to Boeing. We're obviously seeing that reaction in the stock price today. But I think the question going forward, given some of the uncertainty out there, especially when it comes to the macro environment, whether or not Boeing is able to maintain that momentum for the rest of the year, I think is one thing Wall Street's going to be watching.
Still a big question mark there. Well, XPeng shares soaring as Volkswagen plans to invest $700 million in the company and jointly develop EVs for the Chinese market. Under the terms of the investment, Volkswagen will take a 4.99% stake in XPeng. Vehicles are slated to roll off the line in 2026. These are vehicles that are just targeting the Chinese market for a launch of 2026. But certainly big news here when you consider that China is still the #1 EV market. This is an interesting one for me because I think increasingly companies are finding ways to really increase their stake within that Chinese market. Volkswagen really sort of putting that shot across the bow, if you will, with this partnership with XPeng.
Yeah, and Volkswagen needed to do something there because their sales in China actually fell in the first half. And this came at a time where the EV market there grew by 20%. So Volkswagen had better position themselves in the Chinese market, given, like you were just saying, the fact that it is the #1 market when it comes to adoption or the potential there for adoption in the future. All the traditional automakers are trying to position themselves better within China. They're teaming up with the local EV makers in order to do this. When it comes to who is dominating there, aside from the local players, Tesla, obviously a huge player within China. We know Tesla has prioritized China now for quite some time. It's worked out well for the company. They're in a bit of a price wars here as of late. So they're doing everything they can in order to keep chipping away at that market share. But I think we're also looking at some of the other automakers, foreign automakers, focusing more on that space and obviously hoping that that's going to pay off there for the company going forward.
And to your point, the price cuts point to just how competitive that market is. The question I keep asking, and it's not necessarily one in the Chinese market, which one of the Chinese players comes to the U.S.? I think that's another big question mark.
Yeah, it's a huge question mark. And also who would be successful. And then you would think that that would also really reignite some of the price wars that we're already seeing play out here.
Because the way to compete would be with very steep or very low prices.
All right, let's also take a look at Snap here, closing the day in the red, off just about 14%. The company giving a disappointing forecast for the third quarter for Q2. The social media company here posting revenue declining 4% from a year ago. It's the fifth quarter in a row that we have seen a double-digit drop following the results that we got from Snap, really pointing to the fact that the recovery that we are seeing in the ad market in some other companies is going to take a little bit longer to play out with Snap, it seems like.
Well, and that raises the question. It feels like a broken record every earnings season because we see such volatile trading in these Snap shares. How much of what we're seeing play out is Snap specific? How much of it is about the broader industry? And to your point, yesterday we did get numbers from Alphabet that did point to a stabilization in the digital advertising market. Understood that Snap doesn't necessarily compete in the exact same space, but another steep loss for the stock here on a day when one of their other competitors reported stable numbers.
Yeah, and it's also very similar to what we've heard from Snap in the past, really trying and failing, I think, from a lot of measures of really gaining that competitive edge within this space right now. Snap shares down nearly 90% from their peak back in 2021, failing to really generate some of that investor excitement back into shares. All right, let's also take a look at the price at the pump, because pain at the pump gas prices are on the rise. Once again, the national average price for a gallon of regular gasoline climbing to a 3-month high of $3.69 on Wednesday. That's according to the latest data there from AAA. Yahoo Finance's Ines Ferre is taking a closer look at what we're seeing. Ines.
Yeah, Shauna, and these higher prices are coming at a bad time when commodity prices are also higher, agricultural commodities like wheat, for example. And this isn't great for the inflation fight, because we know that consumers are already stretched with their dollars. Also, when the price of energy just goes up in general, other things go up as well. So as you mentioned, that national average for gasoline, that's a 3-month high. Now, since Tuesday, it has gone up 5 cents to $3.69. Diesel also is higher at $3.92 a gallon. Last week it was at $3.86. You're looking at the Wi-Fi interactive board, so you're seeing gasoline futures that are up. Now, what is driving these higher fuel prices? Well, the mounting supply cuts from OPEC and Russia. You've got also some refineries that have not been working because of extreme heat. So just to give you an idea, if you put a refinery offline for about 20 minutes, that can delay days of supplies when it comes to gasoline. Also, gasoline inventories, those are already low. But just to put this in perspective, look, last year you had gasoline averages at 64 cents higher than what they're at today. You had that peak last year of gasoline peaking $5 a gallon. And as far as the agricultural prices are concerned, well, we have seen the commodities going higher because of Russia ending a crucial deal with Ukraine that allowed Ukraine to export wheat. So that has lifted up the price of some agricultural items. And also, guys, there is an unknown, and that is the hurricane season. We are officially in the hurricane season. It gets more active at the end of the summer, beginning of the fall. So we'll have to see what happens there and how that impacts gasoline prices.
Yeah, and that's putting you on the spot just a bit, but how has that typically impacted the price of gasoline? Obviously, I mean, just in terms of if we did see some sort of disruption from these storms, how big of an uptick could we see in prices potentially?
Well, you could see them go higher because, look, the refineries, I mean, if you hit refineries, if refineries have to go offline, that's significant, and that would impact days of supplies for gasoline. So we've seen that before. We've seen these spikes going higher when we have had hurricanes, and we could see that again for sure.
Certainly something that we will continue to watch. All right, Ines Ferre, thanks.
We are seeing shares of Meta soaring here after reporting earnings here for its most recent quarter. You know, Shauna, we were just talking about ad revenue, at least in the digital space, a solid beat here for Meta. When you think about revenue coming in at $32 billion, the expectation was $31 billion. Advertising revenue up 12% year on year, also a solid beat there. Reality Labs, something that's going to come up certainly in the call here. They did see revenue there up 39% year on year, but the operating loss up 33% year on year, coming in at $3.74 billion. Versus the expectation of $3.68 billion. You look at the family of apps, that revenue also a beat. They're up 12% year on year. Facebook pulling back in terms of up about 4.6% in terms of daily active users, monthly active users also up there. I mean, there's a number of questions, Shauna, I think, going into this investor call, because we see this stock up. It is a solid beat, but it is about what the future is with Reality Labs. When do they stop the bleeding there in terms of the loss? And also some big questions here around their generative AI product and how they monetize. It feels like we've been having this discussion around all the big tech companies, certainly no different for Meta, but at least when you think of their biggest driver in digital ad revenue, certainly a solid beat there, which points to the broader trend we've been seeing, which is a stabilization.
Yeah, and I think that that's going to be key just in terms of any insight into AI, how that is benefiting Meta, whether or not how it's going to really improve some of their ad targeting. I think that's a key question for analysts ahead of this call. But when you take into account the reaction that we're seeing in the stock, it seems like the street really focusing on that guidance beat when it comes to 3Q revenue, what Meta is expecting to see. They're coming in better than expected, $32 billion to $34.5 billion. That beat the street's estimate of $31 billion. So that's really, I guess, taking the center stage and outshining some of the losses that we are seeing from there. Meta also saying that they're going to continue to invest in some of these opportunities like AI, but also the metaverse. And we know some of the investments in the metaverse have been called into question from analysts, how much Meta should be spending on that at this point. But again, a huge move to the upside. All right, let's dig into this a little bit further and break down Meta's Q2 earnings results. We want to bring in Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, you've only had a couple of minutes here to take a look at this report. We're looking at a reaction of about 6% in shares in after hours. What's your first take?
I thought the numbers were great. Overall, you kind of look at a beat overall, top and bottom line for the quarter. You pointed out to the guidance. The guidance was also better than expected, both on the top line side of things. It looks like as far as cost cuts are concerned, about half of the cost cut, the employee workforce reduction announced for 2023 has been impacted. So it looks like there's going to be more that gets packed on. Some of those cost synergies continue to flow into Q3. So you continue to see the earnings leverage as we kind of go through the year here. So I think ultimately the results here were very, very good. And I think the stock deserves to go higher, especially given that, among kind of, those Super 7 companies out there, this is the most kind of attractively valued among the group.
Angelo, the ad revenue is still a big driver for the company, and we did see that up 12% year on year. $31.5 billion is what we're looking at. We were talking about just the general trend that we've been seeing, especially in digital ads, sort of a stabilization that's happening. You take Snap out of the picture there. Have we seen the lows of that? Are we going to continue to see the momentum pick up on that front?
I think so. I think the hope by the street was really kind of that we were going to see a bottom in the first half of the year, and we were going to see growth rates really start to accelerate as we kind of progress through the second half of the year. And you're actually seeing some of that acceleration take fold sooner than expected. And when you kind of couple that again with some of the announced cost cuts, not only on Meta's side of things, but Alphabet's with their numbers last night, it kind of shows you kind of the earnings power these companies have as you kind of enter this maybe Goldilocks type of environment for the ad space, in the sense that you're seeing incremental growth, which is allowing you to kind of focus on the operating expense side of things. Whereas, in a time like 2020, 2021, things were growing so violently, it was kind of just, increased headcount at any price. So I think this is actually the perfect environment for a company like Meta as well as Alphabet, which, right now, clearly is getting a bulk of the kind of, customer advertiser budgets out there, whereas a company like Snap is really kind of being hit hard by some of the tighter budgets that are out there.
Angela, how should we be looking at some of these other bets for Meta, specifically the metaverse? If you go back to 2021, they doubled down on the metaverse, changed the name of the company to Meta. Mark Zuckerberg has made it clear this is a long-term play, and you look at the operating losses here increasing within the quarter. In terms of the commentary coming through from the company, Facebook or Meta saying that they expect Reality Labs operating losses to increase year over year in 2023. How do you assess that against all the other revenue drivers? How big of a concern is that loss?
Well, listen, I actually don't think it's a concern. I think that this is it's a great time to be Meta. Actually, it actually pays to be an enormous company with almost kind of unlimited cash out there, and that's kind of something a company like Meta as well as Alphabet kind of benefits from, right? Whereas a company like Snap out there has to aggressively invest to kind of keep up with some of these bigger players, and they're having a hard time doing that because they don't necessarily have that financial power and scale that these bigger companies out there do. So if you're a company like Meta, you want to continue to invest in the future, whether or not you're a believer in the metaverse. I think that's kind of something many investors out there have to struggle with. But as far as Meta is concerned, I mean, I think right now directionally they're aggressively spending in many of the right areas, and that is within AI. And you kind of saw some of the comments out there that investments towards AI is going to go up in 2024 relative to 2023. They're not going to pinpoint a number out there, but we do expect higher capital investments, and it is largely geared towards AI, at least as far as the increase is concerned. What are we believers of the metaverse? I think it is kind of that long-term trajectory. We're not necessarily opposed to them investing in it, but if they were to significantly scale up from these type of levels, I think then investors should be concerned about that.
Angela, one of their new initiatives that did at least seem initially to register with many of its users was their debut of Threads. Over 100 million users in under a week. But I think the big question is where we go from here. And we took to the streets of New York to see how people are feeling about Meta Threads. And I want to play a quick soundbite here from what we heard.
Instagram kind of copying a lot of the things that other apps have been doing.
It's fake Twitter. Like, nobody want to be on Threads if you got the Twitter going. Feel me?
I set up an account. I don't ever go on it.
I didn't feel the need to download it because it didn't feel new.
I can definitely see Threads becoming a competitor with Twitter.
So, Angela, it seems like engagement might be an issue here for Meta. But as they work through that, what are you hoping to hear? How do you see Threads fitting into Meta's overall vision with plans to monetize potentially that platform?
Yeah, listen, I think as far as how we look at Threads out there, I mean, listen, Threads is an enormous opportunity. We think it has the potential to be kind of that fifth major platform out there for Meta over time. Now, that being said, still very early days, and to your point, I mean, hit 100 million in the span of 5 days. I don't think we want to kind of rush the hype on this platform yet, but and we're not forecasting any sort of revenue from Threads here in 2023 or 2024. So we think there is time here. We've got a longer term vision as far as Threads is concerned, but we do think it has the potential to kind of be another big platform and opportunity out there for Meta. But again, it's one of those things where it's more of an opportunity and not necessarily we personally are kind of embedding in our numbers at this point in time yet. But, there is that potential where, you've got billions of dollars of ad revenue that could be tied to that platform over time. But engagement is something that's going to be important. Keeping those kind of new users that have been added and growing that installed base is also going to be something that's important. And that's all going to be dependent on execution on Meta's side of things and whether or not they can make that happen.
Finally, Angelo, another question that's sort of come up on the call in terms of Meta's generative AI product and how they plan to monetize it. I mean, how should we be thinking about that? Because it seems like when you look at the other big tech names, there is so much excitement and the expectation of revenue flowing in from that, since we've learned that you've got to invest more to bring in more later on. How do you think about that in the context of all the assets that Meta has?
So when we think of Meta and generative AI, I'd say they're really kind of Meta's efforts in that AI or generative AI really kind of stems from two areas, right? The first is really kind of improving recommendations, their ranking infrastructure that powers their entire ecosystem, right? Whether it be feed, Reels, their broader ad system. And that's something that they've kind of been doing for quite some time now. They've provided some great numbers, back in the first quarter. We expect them to provide some additional details and greater traction from those efforts here on that side of things. The second opportunity is via new generative AI models, their Llama large language model out there that can really kind of create some new products, experiences out there, and really some emerging AI opportunities, whether it be, whether it relates to AI agents out there or other conversational AI kind of opportunities. So that's something we kind of want to hear more about here over time. And that's really kind of more of a pie in the sky opportunity out there for Meta. But there is some great opportunities out there as far as the company is concerned, both kind of what they're doing right now in terms of, rankings and recommendations out there, as well as some new emerging AI opportunities with their kind of, open-based platform in Llama.
Angelo Zeno, as always, good to get your take. Really appreciate your time today.
Great. Thanks for having me.
Let's do a check of the market sponsored by Tasty Trade. Dow closing higher for the 13th trading day in a row, the longest winning streak that we've seen since 1987. We're looking at gains of just about 82 points. S&P and NASDAQ, though, closing in the red. The NASDAQ off just about 0.1%. In terms of the sector action, biggest losses that we saw today in technology. The XLK closing well off just over 1%. All right, shares of Chipotle trading lower after reporting results. We're looking at losses of just about 7%. Alexandra Canal breaking down the numbers for us live from a Chipotle. Allie.
Yeah, we're at a local Chipotle breaking down the company's second quarter earnings results. We're seeing shares, though, down more than 7% on a same-store sales miss. That's a very important metric for restaurant chains across the board. Overall, though, we're seeing earnings that came in mixed. Revenue roughly in line with estimates, $2.5 billion versus the expected $2.54 billion there. So a slight miss, although it was up 13.6% year over year. Adjusted earnings, that was a beat at $12.65 a share versus the $12.25 expected. But again, same store sales, that is what's driving the decline in the stock price, 7.4% versus the expected 7.7%. We also saw operating margins miss estimates slightly, 17.2% versus 17.6% that was expected. Now, a slight miss on those operating margins, that's probably due to a few factors, one being the heavy investments that we've seen from Chipotle in terms of their tech, their hiring, as well as their expansion plans. The company reiterated plans to open 255 to 285 new restaurants this year. They are also testing new restaurants in the UK and France. CEO Brian Niccol, he says he's very bullish about those global expansion plans, and he called that out in the earnings release, saying in part, quote, "Our employees, technology, and innovation in our restaurants, along with expanding access and convenience in North America and laying the groundwork for international growth, set us up for long-term success." In terms of cost for food, beverage, and packaging, that decreased in the quarter, and that's due to a hike in many prices that we saw last year, along with lower prices in avocados. But in terms of the inflation picture, with the food that you're seeing in front of my face right now, we're not out of the woods yet. With Chipotle saying that the inflation is still very present in ingredients like beef, dairy, salsa, tortilla, beans, and rice, which we have seen from that CPI print. The outlook for 2023, they see Q3 comp restaurant sales to grow in the low to mid single-digit range, whereas the full-year comp restaurant sales will grow in the mid to high single-digit range. So investors are going to want to hear why same-store sales disappointed, especially since we had that chicken al pastor come out in the quarter. Wall Street analysts were very bullish on this menu item, saying it would be one of the most successful limited time offerings, but there was no mention of that at all in this earnings release. So a lot more to be discussed on that call. Again, taking a look at shares, they are just accelerating here, down more than 8%.
It is certainly are. Wall Street taking some issue with this report. Allie, what do you got right in front of you there?
I got the trifecta here. We have burritos, we have guac and chips, and we have my favorite, a burrito bowl. So as you can see behind me, there's a lot of people here right now, and we're not quite at lunchtime, not quite at dinner time, so people are still enjoying their local Chipotle here. I'm personally pretty hungry right now after that Fed meeting, so I'm about to dig into this very shortly.
You got to bring that back to the office here, to the studios. Allie, I was just going to say, it is pretty crowded, given the time right now, 4:20, really in between meal times, but Chipotle's always crowded. All right, Allie Canal, great stuff. Thanks so much.
Here to dig deeper into Chipotle's second quarter results, let's bring in Nick Setien, Wedbush Securities Equity Research Analyst. Nick, your immediate reaction, what stood out to you in the numbers that we got today?
Yeah, it was really the Q3 comp guidance, low to mid single digits versus slightly over 6% consensus. On the other hand, there was a big margin beat, especially at the store level. G&A was higher, so that's why the operating margin missed. But essentially, what we're going to see is, some favorable margin tailwinds into the second half. What I'd like to see them talk about on the call is, transactions versus mix. The Al Pastor was successful, but it was a lower priced LTO. So it'll be interesting to see what kind of a transaction benefit there was at the expense of mix. So I expect them to kind of address that on the call. I'd be surprised if the stock continues to accelerate to the downside. In fact, I think it'll probably end up, going back up towards the close today.
Nick, one of the focal points of this call, I'm sure we're going to hear at least one question, probably a couple questions about the recent expansion plans, what they're doing in the Middle East, the kind of opportunity that provides Chipotle. How big of a boost potentially do you see this move, this franchise model, being for Chipotle down the road?
Yeah, I think it's going to be a minimal boost. It's not going to meaningfully change numbers in any way, especially given that it's a franchise model. And so, I think it's a very long-term play just to expand the markets a little bit faster. Eventually they may buy those markets or look to, grow them a little bit faster with shareholder CapEx as opposed to franchise CapEx. But in the sort of medium term, it's not really going to move the needle much.
Nick, when you think about Chipotle, one of the first restaurants out of the gate in terms of raising prices, as we saw the costs go up, in the last quarter, they did say they don't plan to raise any more. We have increasingly heard that from some of their competitors as well. And I know you look beyond Chipotle. I wonder what you think that says about where the consumer is, and ultimately, what does that mean for a fast casual name like Chipotle?
Sure, we're not surprised that they're not going to raise prices, anymore going forward. And when you look at sort of where grocery prices are versus restaurants, that drives that incremental transaction of that sort of most sensitive customer. And so, for a couple of years there, grocery inflation was ahead of restaurant inflation. The second half of this year, that's completely turned around, and we're going to see some grocery deflation as food costs come down. We're not going to see deflation in restaurants. And so, that's one of the challenges that across the board, the restaurant industry is going to have to face in the second half of this year and probably going into 2024 is that sensitive customer, that most sensitive customer is probably going to look to grocery to save on costs a little bit versus, going out to eat.
So, Nick, where does that leave Chipotle then positioned against some of its peers? Because up until this point, we have seen their customer base willing to go out and spend the money that they need to spend in order to get some of their favorite deals from Chipotle. That hasn't necessarily been the case with some of their other competitors. Is that margin going to be even wider here? Even though if we do see foot traffic drop off a little bit, Chipotle won't feel it maybe nearly as bad as some of the other names within the fast casual space.
Well, that's exactly it. Relative to other names in the space, Chipotle is going to continue to gain market share. And frankly, when you think about the margin headwinds over the last, 2 to 3 years, I'm sure a lot of people in the restaurant business are actually happy with a little bit of a slowdown if that means, food costs are headed lower or labor costs are headed lower. Frankly, we're just too hot, right? And so I think this is actually a better restaurant operating environment than it has been over the last couple of years. And so I am hopeful that margins are going to continue to expand as long as, the food costs are headed in the right direction. And certainly labor, the hot labor market has cooled off a little bit. So hopefully that ends up being a little bit of a tailwind on the margin side as well, even if transactions or comp, to be more specific, decelerate slightly.
All right, Nick Setyan of Wedbush, thanks so much. Again, Chipotle shares under pressure here in extended trading off just about 8%. Coming up, shares of Mattel are also in the red on earnings. What the toy maker has to say about the success of the Barbie movie. Stick around.
because we know that extreme heat can damage crops, it can make people sick, it can make infrastructure buckle and have all these compounding risks, that when heat waves get more intense, economic growth goes down, and this can have compounding economic consequences to the tune of multiple % of GDP per capita over time.
There is a tremendous opportunity to invest in the green transition globally. I think historically we've mistakenly seen this as a trade-off between do we protect the environment or do we continue to prioritize the economy. There are huge economic opportunities for people who want to invest in the green transition.
Water scarcity is one of the most glaring consequences of the climate crisis. So desalination is a vital aspect of what we call climate adaptation. Desalination means taking water from the ocean, removing the salt, and the result is potable water suitable for drinking, cooking, everything else.
The amount of money that people are spending on utilities in a large swath of the country is enormous, and that money has to come from somewhere. If you have a fixed budget and you're spending more of it to just keep the house cool to survive, that money's not going to be spent on other things.
Those excessive heat warnings, the air quality warnings as well, that is giving AC stocks a boost as businesses try and consume less energy. They are upgrading to newer units. And then you also have the tailwind of the Inflation Reduction Act for individuals, for businesses, if they get new heat pumps, if they get new air conditioning units, etc. So that's what you're seeing with this momentum with these stocks.
Welcome back. We are watching shares of Mattel after hours, a company reporting a surprise profit in the second quarter. Earnings per share coming in at 10 cents versus the expectation of a 3-cent loss. But revenue was down 12% on a year-over-year basis, certainly pointing to the fact that it was a challenging quarter here for Mattel. Kiko, consumers pulling back on some of their discretionary spending. Some of that obviously reflected in these numbers being toys here, and that you really have to question what this means for Mattel in the back half of the year leading up to that very important holiday quarter. We haven't even mentioned Barbie.
Well, I was going to say there's been so much excitement around Mattel and the launch of the Barbie movie. Obviously, they had a record initial weekend box office returns there. But at the end of the day, there is a bit of reality setting in. And Mattel, just like so many other brands, really reliant on the consumer. The company talking about the consumer increasingly turning cautious on toys, leading to pull back in sales for North America. And by the way, they also reiterated their full year EPS guidance, which was a bit of a disappointment to some investors who were expecting maybe a big pop coming on the back of that massive marketing campaign around this movie.
Yeah, certainly. And their CEO there, Ynon Krai, is telling our own Brian Sazi here, he was just speaking with him a few moments ago, that he's not too worried about these results. He's very encouraged by the reception that we have seen from the Barbie movie. He's hoping that that's going to translate into pretty strong sales of Barbie-related products down the line heading into the holiday season. They spent so much money on this film. Yes, it is great in terms of publicity. Yes, it's really brought Barbie back into the conversation. Barbie's really taken over the conversation, it feels like, at least in our world, over the last couple of weeks. But whether or not that momentum continues and whether or not the strategy laid out by Mattel, if that's going to give them the edge against some of their competitors.
Well, it is about sort of bringing Barbie, to your point, back into relevancy. You know, what that means for the long term. They've resonated with a newer generation that maybe didn't necessarily really grow up with Barbies. I'm curious if the company sees a template, by the way, for this movie. They have many other toy brands there. Is that something they pursue down the line, given the success that we have seen so far? By the way, some other news coming through from Mattel. Richard Dixon, Mattel COO and president, now going to Gap to lead that name on the back of this success that we've been talking about.
Yeah, and you could argue that's a huge loss here for Mattel, given the fact that he played such an important role and a key role in the revival of Barbie, getting Barbie back into the conversation, and now really making it front and center of the conversation for Mattel now for almost about a year. So the fact that he is leaving the company, the fact that he will no longer be there for Mattel in terms of their helping shape their future direction, that I think is giving maybe Wall Street a little bit of pause.
It's really incredible, right? I mean, when you kind of just stop and think about the turnaround in the image of Barbie just by a single movie. I mean, when was the last time we talked about Barbie this much beyond Mattel and earnings?
It's been decades since I've talked about Barbie. I was never huge into the dolls, to be totally honest, but people grew up, especially in our generation. They love them. They collected everything when it comes to the dollhouses. And you go down the long list of every single Barbie that was created. People spent so much money on it and certainly fell out of the conversation given all the criticism that Barbie has received over the last 10 to 15 years. So the fact that they have been able to make these changes, the fact that it does, at least for now, seem to be resonating with the population, with those people, playing into that nostalgia effect. Obviously, it could be a good move here for Mattel going forward.
Yeah, looking at some other numbers from Mattel, by the way, we should point out inventory levels, something we look at with a lot of these retailers. Second quarter inventory levels down 18% from the previous year, and then full year free cash flow guidance about $400 million as well. Well, a busy day in Washington beyond the Fed decision. Lawmakers on Capitol Hill holding a hearing, yes, on UFOs. 2 whistleblowers calling for more government transparency on sightings. Inez Foray following that story for us. Inez.
Yeah, Kiko, and it was a fascinating hearing. By the way, the government now calls them UAPs. That's unidentified aerial phenomena, but everyone else knows them as UFOs. We heard from David Grush. He's a former military intelligence officer who turned whistleblower. We also heard from former Navy pilots, Lieutenant Ryan Graves. He and others, he says, had seen a dark gray or a black cube inside a clear sphere. Also, Navy Commander David Fravor, who shot the now famous video that's a Tic Tac video. It's called the Tic Tac video. Basically, he said it was an aircraft that he and others saw that had no windows, no wings. It was something that they had never seen before. Look, the purpose of this hearing was so that Congress, lawmakers could probe these witnesses about how they should go about looking into this, investigating this, because what these witnesses are saying is that Congress and the public are kept in the dark about UAPs, and the Pentagon has denied the whistleblower claims. Also, one of the witnesses saying that there's no proper way of reporting these, saying that commercial pilots have seen these, that military pilots have seen these, but there is no proper procedure to report these without fear of losing your job, that there is a stigma attached to these sightings. Take a listen.
UAP are in our airspace, but they are grossly underreported. These sightings are not rare or isolated, they are routine. Military aircrew and commercial pilots, trained observers whose lives depend on accurate identification, are frequently witnessing these phenomena. The stigma attached to UAP is real and powerful and challenges national security. It silences commercial pilots who fear professional repercussions, discourages witnesses, and is only compounded by recent government claims questioning the credibility of eyewitness testimony.
And retired Navy Commander David Fravor also said, look, this is not about little green men. This is really about something that we have never seen before, a technology that is not here on Earth, something that is far superior to what we can do. And so we want to know, where do these crafts come from? What is the technology? How do they operate? And also, why are they here? Is this a friend or a foe? I mean, there was one congressman lawmaker that asked, is there a national threat to for these to be here or to knowing about this? And he said, look, the threat is that this is a technology much, much more superior to what we have ever seen before.
You know, the government tracking more than 650 potential UFO cases. It really puts it all in perspective. All right, Inez, thanks so much. Well, coming up, we check in on a few of the trending tickers moving after hours. Stick around.
goodbye.
Yeah.
Or goodbye. Like,
Yeah. It's yeah. It's not working.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Well, Samsung unveiled its new line of foldable smartphones, and Yahoo Finance's Dan Halley got to take a look at Samsung's packed event in headquarters in Seoul, South Korea. Take a look.
I'm Dan Halley. We're here in Seoul, South Korea, and we are checking out what's new from Samsung. This is the Galaxy Z Flip 5, and this is the Galaxy Z Fold 5. We're looking at 2 foldable phones. Let me just show you a little bit of that. Boop, nice and flat. Boop, nice and flat. And that nice and flat is part of the reason why Samsung is updating these new phones, because they're able to do that with their newest hinges. It's also important to point out that the Flip, which I've seen a lot of in South Korea, has this nice big new screen up front, and when you run through it, you can do different things, check out your weather, check out your appointments, check out everything along those lines. This is probably my favorite device that we're seeing here. This starts out at $999 though, so it's a bit pricey. Then we have the Z Fold 5. This is going to be a lot larger. You have this big front screen here where you can see all of your apps, basically do whatever you want that you would do on a normal phone. But then when you want to game, when you want to watch some movies, if you want to browse the web, yahoofinance.com, you can open this bad boy up, and then boom, that's a much larger display that you can get there. But this is also pretty expensive. We're talking $17.99 for the starting price. So very pricey. A lot of people might not be able to afford that. The key differences here is obviously, besides the orientation, the different types of cameras we have. We have a telephoto, wide lens, ultra wide. On here we have a wide and ultra wide. But I do got to say, I really am enjoying the Flip. And as I said, I'm seeing them everywhere. I've seen a few folds, but Flips people are carrying around all over the place. Right now we have competitors from Google with their own Pixel Fold. We have Motorola with the new Razr Plus. We also have a number of Chinese companies making foldable phones. The big one that's not in the race yet is Apple. We'll have to see what they do in the coming years if they're actually going to roll one out. But for now, Samsung seems to have a really good head start with the Z Fold 5 and the Z Flip 5.
That was Yahoo Finance's Dan Halley at Samsung headquarters in Seoul, South Korea. Shauna, the foldable phones is an interesting one for me. Number one, the price point has been incredibly high, but some new numbers from IDC here, to research firm pointing out that they expect shipments to increase 50% this year. So, that's a positive when you think about the upgrade cycle slowing down within smartphones. Now, Samsung leads the way right now, as Dan pointed out, but they are facing a lot of competition. Google Pixel One, other Chinese firms, including Oppo as well as Huawei, also coming out with their Huawei with their foldable phones as well. It's a cool concept. I don't know if I need it.
I was going to say it's a cool concept. Do people want this? I think that's the question. Yes, I remember the flip phone from when I was in high school, when I was in middle school. It was very popular. Obviously, nothing like what this flip phone is. This one's a heck of a lot cooler. But I think people have gotten so used to what the size of phones are these days when it comes to the iPhone, when it comes to Android. So whether or not they're going to be inclined to get a phone like this, whether or not that's enough of a selling point, maybe, that's the question I would have.
Yeah, if you're looking at a price point of anywhere from $1,000 to $1,800, right? The argument with foldable phones has been that there is not enough reason to buy in. There's not enough apps on it, not enough content, right? The use cases aren't exactly there to justify the pricing. That will catch up eventually, but Samsung trying to maintain its hold and lead in the market at a time when others are still getting in, largely because Samsung's had the technology in place to be able to have these foldable phones in a seamless way.
Yeah, certainly. Well, we'll see whether or not it really gains some popularity. It does look cool. Dan seemed to be pretty excited about it. So
he's always excited about his gadgets.
For me. All right, coming up next, it's closing time here on Yahoo Finance. We'll recap today's top stories, get you set for everything you need to know for Thursday. Let's take a look at a couple of stocks trending after hours. You got Meta, Chipotle, Mattel, and eBay. Kicking it off with Meta, the sole gainer here in extended trading. Shares up just about 4.5%. Pretty strong results here from the company. Its most recent quarter, double-digit revenue growth. They posted this for the first time since the fourth quarter of 2021. Third quarter revenue forecast also coming in better than expected. Daily active users topping the street's expectations. Monthly active users over 3 billion over the last 3 months, looking at gains of just about 42%. Year to date, gains of 148%. Of course, Meta has been one of the big beneficiaries of this AI-fueled rally that we've seen since the start of the year. We'll see whether or not that momentum carries on from here on out. Let's take a look at Chipotle. That stock off over 9% right now. The company share sliding after its sales fell short. Higher prices on tortillas, on dairy, beef, pressuring some of the company's profits here in its most recent quarter. Also, their comp sales, that fell below Wall Street's expectations. Big reason why we're seeing the stock in the red here in extended trading over the last 3 months. We're only looking at gains of just about 4%. Let's move on to Mattel. That stock off about 1% right now. Sales down 12% from a year ago. Adjusted EPS down 44% from a year ago. The Barbie movie, that of course has been all the hype, everything that we've been talking about when it comes to Mattel over the last several months. Those results not reflected in these quarter's results, but Mattel hoping that some of that hype, it's going to boost sales for their very, very important holiday period here in the second half of the year. Over the last 3 months, we're looking at gains of 25%. We've already seen some of that hype in just the last month alone, with Mattel shares rising about 17% ahead of the Barbie movie release last week. All right, let's also round it out with eBay. That stock off about 4.5%. Consumer story here playing out. We're seeing that reflected in the stock price here. Profit outlook disappointing. They're clearly has been losing some market share to some of their competitors out there. We've seen a bit of a strategic shift here from management, trying to focus on maybe some of the higher priced items, hoping that that is going to improve sales from here on out. One highlight, though, in this report, ad revenue did come in better than expected at $367 million over the last month, gains of about 12%.
What is closing time here at Yahoo Finance? Here's a look at some of the top stories of the day. The Fed raising highest level in 22 years. The central bank raising rates by a quarter point as expected. Fed Chair Jay Powell saying at his news conference that he sees a soft landing for the U.S. economy and that the Fed will not be cutting rates this year. Tesla's charging network is facing new competition as 7 automakers join forces to create a new high-powered charging network. Those 7 major car makers will be teaming up to help get anxious EV buyers get over that range anxiety. The group includes General Motors, Stellantis, Hyundai, Kia, Honda, BMW, and Mercedes-Benz. And a change at the top for the Gap. Finally, the retailer poaching Richard Dickson from Mattel to be its next CEO. Dickson was president and chief operating officer at Mattel. He's credited with Barbie's turnaround. Gap has been searching for a CEO for a year since Sonia Sengal left.
Time now for what to watch for Thursday. First on the list, the Commerce Department will be giving the first look at second quarter GDP. Estimates are pointing to annualized growth of approximately 1.8%. And sticking with economic data, the U.S. Census Bureau will be out with new orders for manufactured durable goods for the month of June. Expectations are set for a 1.2% rise after May saw durable goods orders rise more than expected. Switching on over to earnings, it's a busy day ahead for investors. A slew of names are set to report their latest quarterly results. Among that long list of names, Intel. Traders will be looking to see if earnings will give any indication if the chipmaker can hope to potentially catch up to NVIDIA and AMD when it comes to the AI race. Meanwhile, auto investors will have their eyes set on Ford to see if the company will have good news ahead for investors and following GM's footsteps in raising guidance. And traders are also going to get a good look here at McDonald's and Sweetgreen. Positive sales momentum is expected to continue for fast food giant McDonald's, boosted by the viral Grimace Shake promotion, digital sales, and market share gains. Meanwhile, the pressure is on for Sweetgreen to deliver an appetizing earnings report after Kava's IPO success. Sweetgreen expected to report their latest quarterly results after the bell. That'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. See you then.